Hello, fellow compounders. Welcome back. In our last episode, we uncovered the truth behind some common myths about dividend investing. If you haven't seen that video yet, here's the link. Today, we're continuing this journey, diving into 4 more myths, especially focusing on growth potential and the strategic value of dividend stocks in various investment portfolios. Whether you're a young investor or planning for retirement, understanding these aspects of dividend investing is crucial. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you're responsible for your own financial decisions. Myth number 5. Dividend stocks don't offer capital appreciation. Myth number 5, dividend stocks are all about income and don't offer much in terms of capital appreciation, is totally false. This couldn't be further from the truth. Microsoft, a renowned tech giant, is not only a dividend payer, but has also experienced phenomenal stock price growth over the past decade. This is a testament to the fact that investing in dividend stocks doesn't mean sacrificing growth potential. Then there's Johnson & Johnson, a staple in many dividend-focused portfolios. J&J is a dividend king, known for its consistent dividend increases over 59 consecutive years. It has also provided substantial capital growth over the long term. If you had bought $1,000 worth of J&J at IPO back in 1944, now it would be worth over $10.3 million. This healthcare giant has shown that a company can offer both reliable dividends and stock price appreciation. Home Depot is another example that breaks this stereotype. As a leader in the consumer goods sector, it has been a remarkable growth stock while also offering consistently increasing dividends, reflecting strong financial performance and a commitment to returning value to shareholders. These cases illustrate that dividend investing doesn't have to be a trade-off between income and growth. With careful selection, focusing on companies with solid fundamentals and growth prospects, investors can enjoy the best of both worlds: steady income and capital appreciation. As we've seen, the landscape of dividend investing is rich and varied, offering opportunities for both income and growth. But what about younger investors? Let's bust another myth that's particularly relevant for them. Myth number 6, young investors should ignore dividend stocks. This is a widespread notion, but let's see why it's flawed. Dividend reinvestment plans, or DRIPs, DRIPs, are a fantastic tool for young investors. They allow dividends to be reinvested, harnessing the power of compound interest to grow investments exponentially over time. Take Coca-Cola, for example, a dividend king. It's a company that has been increasing its dividends for over 50 consecutive years. Young investors buying Coca-Cola shares and reinvesting the dividends would not only benefit from the dividends themselves, but also from the compounding effect over decades. Another great example is Apple. Since initiating dividend payments in 2012, its stock has split multiple times and the dividend has grown. Young investors who invested early in Apple and reinvested their dividends would have witnessed considerable growth in their portfolio, benefiting both from dividend income and the stock's capital appreciation. I personally bought Apple about 10 years ago for around $19.50 per share, adjusted for splits. And now that share is trading around $195. That's close to 900% return in 10 years. These examples highlight the potential of dividend investing as a powerful tool for young investors. It's about long-term growth, not just immediate income. Starting early with dividend stocks and reinvesting those dividends can set up a foundation for a robust portfolio, benefiting from both the steady stream of dividends and the power of compounding over time. Dividend stocks can indeed be a key for a balanced, growth-oriented investment strategy for investors of all ages. But what about the ease of dividend investing? Let's delve into another myth. Myth number 7, dividend investing is straightforward and easy. It might seem simple: pick stocks with high dividends and wait for the money to roll in. However, the reality is much more nuanced. AT&T serves as a cautionary tale. Known for its high dividend yield, AT&T announced a significant dividend cut in 2021 as part of its restructuring plan. Investors who thought they had a shorting with its high dividend yield were caught off guard. The energy sector, particularly during the 2014 to 2016 oil price crash, provides further insight. Companies like BP and ExxonMobil, known for their solid dividends, faced challenges. While ExxonMobil managed to maintain its dividend, it was a difficult decision and not without risk. BP, during the Deepwater Horizon crisis, had to cut its dividend. These scenarios show that understanding industry dynamics, company debt levels, and overall business health is crucial. The payout ratio, that means the percentage of earnings paid as dividends, is also an important metric to consider. A company with a high payout ratio might struggle to maintain its dividends, especially if earnings drop. Successful dividend investing involves thorough research, understanding the company's financial health, the industry it operates in, and broader economic factors. It's not just about high yields, but finding those that can sustain and ideally grow their dividends over time. Clearly, dividend investing is more complex than it might appear. But don't worry, we're here to navigate these complexities together. Up next, we'll discuss the final myth of our series, so stay tuned. And remember, for more in-depth analysis and investment strategies, hit that subscribe button. Myth number 8, dividends are only for income, not retirement growth. Our final myth for today is dividends are only good for current income, not so much for retirement growth. This is a common belief, but let's explore why it's not entirely accurate. Dividends can play a crucial role in both income generation and capital appreciation in a retirement portfolio. Johnson & Johnson's, for instance, with a history of increasing its dividends for over 59 years, it's not just an income stock, it's also a growth strategy. Investors who have held on to the stock have seen significant appreciation in value over the years, showing the growth potential of well-chosen dividend stocks. Procter & Gamble is another example. It has been increasing its dividend for 63 consecutive years, and it also exemplifies steady capital growth over the long term. These consistent dividend increases, combined with stock value appreciation, make it an attractive option for retirement portfolio. Moreover, dividend growth investing, focusing on companies that consistently increase their dividends, can lead to substantial long-term returns. These companies are often well-established with strong business models and financials, allowing them not only to pay dividends, but also to grow and expand, leading to capital appreciation. This growth can be a significant factor boosting retirement savings. So when planning for retirement, consider the growth potential of these dividend-paying companies. With a well-thought-out strategy, dividend stocks can contribute significantly to both the income and growth aspects of your retirement portfolio. And there you have it, 8 common dividend investing myths, thoroughly debunked. We've explored the diverse and dynamic nature of dividend stocks, highlighting their potential for income, growth, and strategic value in various investment scenarios. Remember, informed investing is key to building a robust portfolio. For more insights on dividend investing and building wealth, make sure to subscribe. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.